Sarah, it's great to be on talking with you as well. So it's building on the direct listing that was launched just a couple of years ago. And as you recall, with the direct listing, it was really an idea that was the brainchild of Barry McCarthy, the CFO of Spotify, who said, I want to decouple capital raising from going public. His goal of becoming a public company wasn't necessarily to raise money, so he was questioning why he needed to use an IPO. So what they did was come to the exchange, and we helped through our mechanism of the way we trade stocks every single day, price their first day of trading through the exchange's model on the trading floor. So our market makers, in conjunction with the investment community, priced Spotify's first trade. Slack followed suit, and we've seen a few other companies, Palantir and Asana most recently, use that mechanism to become a public company. But in all of those four cases, they weren't raising money at the time of their listing. And so for the past 18 months, we've been working with the SEC on the ability to raise primary capital, price that primary capital offering on the exchange at the time of the opening trade, which means that instead of in a traditional IPO where shares are sold the night before by the company or their early investors or employees to a small group of the market, small group of investors, and then the first day of trading really sets their market price. We combine those two things to be exactly the same trade at the exact same time so that everyone's on a level playing field. I mean, what's really great about it is it democratizes access to that public listing on the exchange the first day of trading.
So how exactly does it affect Wall Street? I guess the idea here is that the fees would be lower to the bankers, which is why venture capital and a lot of the tech firms really like it. But what is the mechanism for how that capital is actually raised? Is it underwritten? Is it in a private placement? All of those would still require fees, wouldn't they?
So it's actually one of the things that is important to distinguish between is it's not about the fees to the banks. The banks are still providing services to companies when they choose to do a direct listing, and they get compensated for providing that value to them when they're working with them. It's about the cost of capital. If they sell shares the night before to a group of investors without having all investor interest as part of that offering, they're going to likely sell it at a lower price than what the market demand might be. You know, you're just not getting the full view of what all interest is. And so it's really that discount that they're trying to avoid. It's not so much fees that get paid to Wall Street as much as not having the full benefit of the market to price their shares. So just think about all those examples when we see an IPO pop on the first day, and there are shares allocated the night before, and it gets priced at a certain level, and then the next day it's up 100%, and people say, well, that's a great IPO. Look at how wonderful, exciting this company is. It's not a great IPO if you were the one that sold shares the night before, because you could have gotten a much better price if everybody was participating in that offering. So that's what a direct listing with primary capital raise is designed to do. The company becomes a seller on the New York Stock Exchange opening auction, just like any other sellers out there in the market. And that allows for one price to all buyers and sellers on a level playing field as we look to price that offering at the same time. So if you think about an IPO, there's two pieces to it. There's the initial public offering where shares are sold the night before, and then the first day of trading really sets the market price. In a direct listing with a primary capital raise, you're putting both of those events at one price at the same time on the New York Stock Exchange the morning of the first day of trading. The company, their early investors, their employees can be part of that initial sale at the same price as all investors.
But the primary capital raise can be done, according to the SEC, though, Stacey, without an underwriter, right? And if that is the case, doesn't that increase the liability on the company itself and then the risk on the individual investor who, in a sense, has no guidance on what the fair or true price of a share of stock issued should be?
Importantly, these are still registered offerings. All of the federal securities laws still apply. The company, as part of their S-1 filing, as they do with an IPO, includes a price range of where they indicate the stock where the sale might occur for their primary offering. They still do that. Our mechanism at the NYSE with the direct floor listing provides that range so that investors have visibility and transparency into where the stock will open. A range. It could be a much wider range than might be in an IPO because they don't have the benefit of having that investor visibility yet of knowing where investor demand is. And if for some reason the company is going to price outside of that range, the trade doesn't happen. So investors do have transparency into how the stock might open that morning, and still all the federal securities laws apply.
Shepard Smith here. Thanks for watching CNBC on YouTube.